Okay, so let's continue from where we left. In our previous class, we discussed how to prepare a group income statement or a group statement of profit and loss. So, but we left some things which I want us to complete now on those items that we remain with to finish today. But before we touch on what we were remaining with, let me remind you very fast, we said how to consolidate. And again, remember we said this is not a new topic to you. You must have done it in section 3. So for now, we are just reviewing them because you need this information again, even at this level of section 6, you still need this level of information. So let's remind ourselves very fast how you used to consolidate an income statement, which we also talked about in our previous lesson. It's only that we left some things. So we said to determine the group sales, when you're determining the group income statement or group consolidated profit and loss, when you are preparing this consolidated profit and loss, we said you normally start by taking the sales of the holding company plus the sales of the subsidiary company. Then we said, if there are any intercompany sale of goods, I hope you remember, we said you should deduct them. That one is what we said. So for now, let us assume again that our goods, intercompany sale of goods amounted to 100,000. That is what we said you minus. Then we said, whatever you get, that becomes the group sales. From there, we said, you come to the next one, which is the cost of sales. We said you take the cost of sales of the holding plus the cost of sales of the subsidiary company. Then we said, whatever is the intercompany sale of goods again, whatever is the intercompany sale of goods between the group members, again, that one you minus, which in our case again is 100. So any intercompany sales, we said you remove them from the sales of the company that sold, and we said you also remove them from the purchases of the company that purchased. That one I hope you remember. Then we went further and said, if the same intercompany sale of goods give rise to what we called unrealized profit on closing stock, we said that unrealized profit on closing stock should be added. So we were saying any unrealized profit on closing stock should be added. Any unrealized profit on closing stock, we said should be added. Then we went further and said, what if there was also an unrealized profit on opening stock? We said if there's an unrealized profit on opening stock, I hope you remember, we said you deduct. That's what we said, you deduct any unrealized profit on opening stock. We said you have to deduct. Then we said if there are no other adjustments, assuming there are no other adjustments affecting cost of sales, then we said that's what you get as the group cost of sales. That's what we said you deduct. Then from there, we said you get the gross profit. Then you move to the next item, which according to the income statement, the next item is what they are calling admin expenses. So we said again, take the admin expense of the holding plus the admin expense of the subsidiary company. For now, we are assuming there is nothing like any item adjustment affecting that group admin expenses. For now, we are assuming, but later we shall come across what if there are some items that should be adjusted later. That is not now. But for now, we are assuming there are no adjustments. Then from there, we said, once you do that, you go to the next item, and the next one is what we call distribution expenses. Again, take the one of the holding company plus the one of the subsidiary company, whatever they are. Again, we are assuming there are no adjustments affecting it. So we just combine those two and you minus. From there, we said, if you are told that the goodwill of the subsidiary company suffered an impairment loss, we said whatever is the goodwill impairment, that amount of the impairment, we said should be charged in the group cost or in the group profit and loss. So any impairment of goodwill, the question will tell you whether goodwill has been impaired or not. And if this year goodwill has suffered any impairment loss, that impairment loss, we say that's where you charge. Then from there, we said you get what we called profit from operations. Profit from operations. I'm just reminding you what we said last time, Then from there, we said you come to what we called finance cost, where we said you take the one of the holding plus the one of the subsidiary company, whatever it is. That's what we said you minus whatever it is. Then from there, we said you go to the next item, and the next one is investment income. That one I do hope you remember. We said that one I hope you remember. We said you don't just add these two. No, don't add the one of the holding plus the one of the subsidiary to become the group investment income. I hope you still remember we said to determine the group investment income, only that income that the group received from an outside source. It's only that income that the group received from an outside source that should go to the group profit and loss. Only that income that the group received from an outside source. We said any intercompany income or dividend should not be consolidated. Any intercompany dividend or income should not be consolidated. So we were arguing and saying, how then do you determine what was the investment income that the group received from outside? I do hope you remember. We were assuming, for example, if the question gives you that the investment income of the holding company is, let's assume, 100,000, and the investment income of the subsidiary company is, let us assume, 60,000, we said, I hope you still remember, we said the investment income of that subsidiary company, whatever the subsidiary company is reporting as their investment income, it is obvious that income the subsidiary company is reporting, which is in this case 60,000, that income could not have come from a group member. Why? Because we are looking at these two companies now, that is the holding and the subsidiary company as one company. We are looking at the two as one company when you are preparing group accounts. And so we are saying, now that we are looking at the two as one, the one the subsidiary company has reported, as their investment income, we said that investment income for the subsidiary company could not have come from a group member. Why? Because the subsidiary company, we said, does not invest in the shares of the holding. Instead, we said it's the holding that invests in the shares of the subsidiary company. So if the subsidiary company has an investment income, then they must have received it from other investments they have, but not from within this group. So that 60,000 the subsidiary company is reporting as their investment income, that 60 we said came from outside the group, and therefore their investment income should obviously be reported as part of the group investment income. So we said for the subsidiary, you pick theirs. I hope you remember that one. We said there is no question about it. Just pick it and bring it to the group. Why? Because the subsidiary could not have received it from the holding company. The one we said you must be very careful about is the one of the holding company. That's the one we said you should be very careful about. How to determine whether part of this 100,000 the holding is reporting, whether part of it came from within the group or nothing came from the group, or all of it could have come from the group. So I hope you still remember how we were considering or reconciling to see how we determine the group investment income. I hope you still remember we said to know how much out of this 100 the group has received, or the holding company has received from a group member, we said you come down and find out how much are the dividends. That's what we said. Go to the income statement of the subsidiary company, find out what have they paid as dividend. Find out what have they paid as dividend. And we were assuming, suppose they have paid their shareholders dividend of 80,000. Assuming they have paid their shareholders dividend of 80,000. And so we said, if the question tells you that you are controlling 80% shares in this subsidiary company, then we said, now that me as a holding company, I'm controlling 80%, and they paid their shareholders, that subsidiary company paid their shareholders 80,000 as dividend. I am one of the shareholders, me as a holding company, I'm controlling 80%. We said you must have been paid 80% of these, and therefore 80% of the 80,000 we said is what you must have received from your subsidiary. Why? Because you are controlling 80%. The subsidiary company has paid their shareholders dividend of 80,000. So you as a holding company, you must have been paid 80% of that 80,000. And that we saw is 64,000. That one we can see is 64,000. So it means therefore, out of these 100,000, 64,000 obviously came from a member of the group. Out of the 100, 64,000 we said came from a member of the group. And therefore we said it means therefore that there's another 36,000 this holding company has reported as part of their investment income. It is obvious that 36,000 did not come from S. S being a group member, the holding company did not receive the 36,000 from S Limited, no. So the amount they received, you H Limited, the amount you received from a group member, which is S Limited, is that amount of 64, which we said you should never consolidate any intercompany item. Never. You should never consolidate any intercompany item. And so we said that 64 should not form part of the group investment income. But what this holding company has received from elsewhere, which in our case now we are concluding is 36,000, that one we said last time that 36,000, it's obvious the holding company could not have received it from a group member, could not have received it from a group member. They must have received it from elsewhere. That elsewhere is an income they received from an outside source. So H Limited also must have received 36,000 from an outside source. And so we said it is that 36,000 that should become part of the group investment income. So in your group investment and your group income statement, that's what you will reflect, and that's how we said you reconcile. So we said you reconcile what the holding company has accounted for as their investment income, reconcile it with the dividends paid by the subsidiary company, reconcile it with the dividends paid by the subsidiary company. So that is just to remind you what we mentioned last time. And then we said you get what we are calling the group investment income. Once you do that, then we said you come and get what we call profit before tax. Then we go on and pick the tax charge. We go on and pick the tax charge. We said last time, the tax charge, you don't have any issues. Just pick the one of the holding company plus the one of the subsidiary company. You pick the one of the holding company plus the one of the subsidiary company, whatever it is. That's what we said. Then we said whatever you get, that is what becomes the profit after tax. That's what we said becomes your profit after tax. Then from there we said, now you don't go to the next item. I hope you remember. We said you don't go to the next item. We said after you have determined your profit after tax, we said what do you do next? We said you now go and remove what belongs to outsiders. We said you now come and remove what we call non-controlling interest, or what we used to previously call minority interest. Remember we said you have been consolidating everything of the subsidiary as though you control 100%. You have been consolidating everything of the subsidiary as though you have been controlling 100%. Yet you have not been controlling 100%. You have only been controlling 80%. But because the rule of consolidation says you consolidate as though you control 100%, you took everything of the subsidiary company. Now a time has come to give outsiders who control 20%, a time has come for you to give them their share of the profit, for you to give them their share of the profit. And so in summary, we concluded by saying, now that a time has come to give minority shareholders, or what we call non-controlling interest, their share, we said you come and pick, maybe if you are controlling 20%, 80%, we said you take 20% of what? We said you take 20% of one. We said you go to their income statement, that is the income statement of that subsidiary company, find out what is their profit after tax. Whatever is their profit after tax, we said that profit after tax is all part of this, is all part of this. I hope you do remember. And so we said you just come and pick 20% of the profit after tax of the subsidiary company, That's what we say. You go and pick 20% of the profit after tax of the subsidiary, not of the profit after tax for the group. I do hope you remember. Then we said, there are times when, once you have minus, there are times when the question may be framed in such a way that we don't just take 80% of 20% of their profit after tax. We said there are times when you don't just take 20% of their profit after tax. That's what we said we shall discuss in details today. That's what we said we shall discuss in detail today. But before we go back to that area, let me just try and finish. For now, we are assuming there are no adjustments. Then from there, I do hope you remember, we said you come and pick the dividends. Dividends, we said, that one is always a free mark, and I hope you still remember. We said that dividend, you pick which one? We said you pick only for the H only. We went further and explained how you deal, or why you pick the dividend for the holding company only. I hope you remember those two reasons. I don't have to go back to the previous class or the previous lesson. Then from there, we said once you minus the dividend, which is for the holding company only, we said you get what we call retained profit for the year. We said you get what we call retained profit for the year. Then we said once you get the retained profit for the year, you come and now add what we call retained profit brought down. What we call retained profit brought down. That one we also discussed. And we said for you to determine the group retained profit brought down, what did we say? For you to determine the group retained profit brought down, we said this. The one of the holding company, whatever the holding company is reporting as their retained profit brought down, whatever it is that the holding company is reporting as their retained profit brought down, for now, let us assume it's 20 million. Maybe our figures are in thousands. It's 20 million. We say that 20 million should be part of the group income, The one of the holding company, we said should be part of the group income. Then from there, we said, what about the one the subsidiary company is reporting? And we are saying, assuming now the question told you the retained profit brought down of the subsidiary company is 10 million. I'm putting the figures in thousands, so I'm assuming you are given 10,000. We said, how then do you know whether you are entitled to something out of the brought down of that subsidiary company or you are not entitled? That's what we also emphasized last time. And we said for you to know whether you are entitled to or not out of the retained profit brought down of that subsidiary company, we said in that case, therefore, you must answer the following question. We said you must know whether you are dealing with your subsidiary as a case number one, where we said case number one could be a scenario where you acquired your subsidiary in between the current year. Maybe you acquired your subsidiary company on 1st July, but by January this year, which is the beginning of the year, their brought down is 10 million. We said, if you are given a question of that nature, do you think we said you are entitled to something out of the 10 or you're not entitled? It's obvious. I hope you still remember. We said for such a case, you as a holding company, you can't take anything out of the 10 as a share of income. No. Why? Because we concluded and said this is the profit they made before you acquired them. That's the profit they made before you acquired them. And therefore, that profit is what we called pre-acquisition profit. That profit is what we called pre-acquisition profit, and so you are not entitled. Then we said another case the examiner might give you is a scenario where, again, you could have acquired your subsidiary company by the beginning of this year. You acquired your subsidiary company by the beginning of this year. And that beginning of the year also happens to be the time you acquired that subsidiary company. And maybe the retained profit by the beginning of this year was another 10 million. So we concluded by saying, if you acquired your subsidiary company by the beginning of the year, at a time when the retained profit was 10 million, we say, are you entitled to any share of it? will you now claim as a holding company you have a share out of this? What did we say last time? We said, again, you will not be entitled to anything out of the 10. Why? Because we said that profit was the profit made by the subsidiary company before you even acquired them. That is the profit they had been retaining for the many years up to the date you acquired them. And so that profit of 10 million, we said, is all pre-acquisition profit, is all pre-acquisition profit. And so we said, you as a holding company, you are not entitled to anything out of it. And so we said, again, for that case number 2, you can't claim you have a share of income out of the 10. That was what we were referring to as case number 2. But we came across another case, which I hope you remember. What was that kind of a case? What was that kind of a case? That if the in question for the subsidiary is not a case 1, it's not a case 2, we said it can which other case? We said it could be a question where again, maybe you acquired your subsidiary company many years ago. Maybe you acquired your subsidiary company many years ago. Let us assume maybe on 1st January 2007. At that point in time, when you acquired that subsidiary company, maybe their retained profit at the time of acquisition was 3 million. Then you are told by the beginning of this year, maybe 1st January 2010, I'm assuming our current year is 2010, that by the beginning of this year, 2010, maybe the retained profit by the beginning is now 10 million, which is what they are giving you. And so we concluded by saying, because I was there at that time, when they have a retained profit of 10, I was a shareholder. When I acquired that subsidiary company, their retained profit that time was 3 million. These guys continued retaining, up to the beginning of the year. They have so far retained 10 million. We concluded by saying part of that 10 million was the profit the subsidiary made before I acquired it, and part of that 10 million was the profit the subsidiary made after I've acquired them, So we had to split that 10 million into 2 parts. That's what I hope you remember. We had to split that 10 million into 2 parts. How much of it we considered as pre-acquisition profit, and how much out of the 10 is what we were calling post-acquisition profit. We said, remember, why you as a holding company, you invest in a subsidiary company, you normally invest so that your investment can give you a share of income in the future. So if I acquired my subsidiary company on 1st January 2007, and that time they had a retained profit of 3 million, we have agreed that profit was what they made before I acquired them. And therefore, me as a holding company, I am not entitled to anything out of the 10. I am out of the 3, sorry. Why? Because it was all profit made before we acquired it. But we can see after I've acquired that subsidiary company and up to the beginning of the year, after I've acquired them and up to the beginning of this year, that subsidiary company retained an extra 7 million, So that 7 million is the retained profit they made, or the profit they made after I've acquired them and up to the beginning of the year. And during that time, when they were making that 7 million, I was already a shareholder, me as a holding company. And so you can claim you are entitled to your share, out of the 7 million. So we concluded by saying, this is what we concluded last time, that the only time when you as a holding company, you are entitled to anything out of the brought down of the subsidiary company is when their retained profit brought down has an element called post-acquisition retained profit brought down. So we said you will have to split the 10 million. How much of it is what we were calling pre-acquisition? And out of the 10 million, how much of it do you call post-acquisition retained profit brought down? Don't forget the 10 is still the retained brought down, but out of that 10, 3 million is what we can classify as pre-acquisition retained profit brought down, while 7 million is what we can classify as post-acquisition retained profit brought down. So because you are there when they were making that 7 million, then we said you can claim your share and take maybe 80%. If you are controlling 80, we said you take 80% of that and consider it as your share of income. It is that share of yours that looks like 5.6 million that we said you now combine with yours. You now combine with yours, and that is 5.6 million, whatever it is. So that's what we said you do on how to determine the group retained profit brought down. That's how we said you determine the group retained profit brought down. And so we concluded by saying, the only time you are entitled to the share of the post brought down, for a share of their brought down, is when you are dealing with a subsidiary company as a case number 3. So whenever you see a question and it's a case number 1, or you see a question and it's a case number 2, then you automatically should conclude, that's what we said, you should automatically conclude that that brought down, whatever they are giving you in those 2 cases, all of them being pre-acquisition, then we said you don't take anything out of it. The only time you are entitled to is when you are dealing with a subsidiary as a case number 3, whereby we said you are entitled to something out of their post brought down. Now, last time we also mentioned, which you will also tell me, yes, as much as you are dealing with your subsidiary as a case 3, we went further and said there are times when again, you don't just take 80% of the 7 million. There are times under some circumstances where you don't just take 80% of the 8 million, of the 7 million. That's what we said. As much as it's true that 7 million is post-acquisition profit, we said you don't just take 80% of that. So that's what we shall discuss in a short while. So the 2 areas I want us to complete today, as far as the discussion is concerned, is that area of what else can affect this retained profit brought down. The other area I want us to finish is what can affect the determination of the minority interest. That's what I want us to discuss. Now, so let's go back now to the discussion of how you determine the amount belonging to the non-controlling interest. In the group income statement, we said you normally add everything of the subsidiary company, and then once you add everything, a time normally comes when you say, but you're not controlling 100%, you are controlling 80%, meaning 20% of what you have been bringing in is not yours. And so we said in simple, when you are determining when you are preparing the group profit and loss, we said once you get the profit after tax for the group, we said you now come and remove what belongs to the outsiders. Those are the non-controlling shareholders, or what some books will still call minority interest. But we said you don't just go and pick their profit after tax. We are saying, assuming from the income statement of this subsidiary company, they have given you their profit after tax. Assuming they have given you their profit after tax to be something like 10 million. We say you don't just pick 20% of that and bring it here as 2 million. We only do that if there are no issues. But we say there are times when there could be some issues. And those are the issues I want you to remind me from what you did in this topic as far as your section 3 is concerned. So remind me, what are some of the things that can also make you as a holding company not to just take 20% of this profit after tax? What are some of those items that made you as a holding company not to just take 20% of the profit after tax of that subsidiary company? So remind me what you did in your section 3, because that's where we want to pick up from today. That's what we want to do. I've just reminded you the other things very fast. Hoping you have got that. Then we are now saying what we left last time is we had just said that to determine the amount of non-controlling interest, just take 20% of their profit after tax. But now we are saying not always. So now we want to ask ourselves, what can make you not just take 20% of their profit after tax? Of course, this is not a new topic. You must have done it in your section 3. So what are some of those items? Okay, we say it, or you know from your section 3, one of them is when there is what we call unrealized profit on closing stock. Unrealized profit on closing stock. And this only occurs where you are told by the question, it is the subsidiary company that sold the goods to the holding company. Only when it is the subsidiary company that sold the goods to the holding company, and that by the end of the year, the holding company has not sold all the goods. So assuming they gave you as an additional information somewhere that the subsidiary company sold goods this much to H Limited, and by the end of the year, H Limited had not sold half or a quarter of the goods, then you calculate the unrealized profit, and you find maybe the unrealized profit is 1 million. So when the subsidiary company sold, on their own, they recognized a profit of 1 million. That's okay for them because they sold. Yet by the end of the year, the holding company had not sold the goods, either all or part. So we have computed the unrealized profit to be 1 million. So we are saying if the unrealized profit was 1 million, that being the profit as on their own made, being the profit as made on their own, it means whatever profit they are giving us, whatever profit they are giving us to be or as being their profit after tax, that profit is automatically wrong. That profit is automatically wrong. It is more than they should be, or it's more than it should be as far as the group is concerned. It is more than it should be as far as the group is concerned. Why? Because it is the profit the subsidiary made. So we are now saying to determine the pure profit after tax of that subsidiary company, you will take the profit after tax of that subsidiary company, then you less what we are calling the unrealized profit, and it is on the resultant amount. It is on the resultant amount that one should compute the non-controlling interest, which is the same as non-minority interest. So you now take maybe 20% of the amount, assuming you are controlling 80, non-controllings are controlling 20%. So you take 20% or whatever the percentage of the minority, whatever the percentage of the minority. So I've explained to you one of the things that sometimes used to make you not just take 20% of the profit after tax of that subsidiary company. I've explained to you one of the things. That is unrealized profit on closing stock, and only where it is the subsidiary company that sold the goods to the holding company. And that by the end of the year, the holding company has not sold either all or part of those goods. The second circumstance that normally or usually you found, which could not make you to take 20% of the 10 million is what? Is when there is what we call depreciation adjustment due to fair value adjustment. Depreciation adjustment due to fair value adjustment. We discussed these when we were doing the statement of financial position discussion. We discussed how to deal with the depreciation adjustment. And so if the subsidiary was supposed to revalue, you are told by the additional information, they were supposed to revalue, but they never revalued. I hope you remember when we were discussing our statement of financial position workings, we saw a fair value adjustment as one of the adjustments normally that affects the statement of financial position. It can also affect the income statement. And I remember we were saying something like this. Suppose you acquired your subsidiary company on 1st January 2007, That's what we were assuming. Suppose you acquired that subsidiary company on 1st January 2007. And we were assuming in the previous discussion, when we were looking at how to deal with fair value adjustment, we saw, suppose one asset has a book value of 10 million, but the fair value of that asset was 12 million. I do hope you remember in our previous class discussion, not in the last one, but in the other class, we saw that if this subsidiary company was supposed to revalue from 10 to 12 and they never revalued, then automatically we concluded that the subsidiary company must have been wrongly depreciating. I hope you remember that. The subsidiary company must have been wrongly depreciating. Why? Because if they were supposed to revalue from 10 to 12 and they never did it, then it means they went on depreciating on 10. Last time, we were assuming, suppose the question tells you the useful life is 5 years. So it means every year, your subsidiary company was charging 2 million, but had they revalued from 10 to 12, they should not have been charging 2 million. They should have been charging how much? Over the same useful life of 5 years, our subsidiary company should have been charging 2.4 million. Then you remember, we were assuming, suppose we are consolidating on 31st December 2010. Suppose we are consolidating on 31st December 2010. That's what we were assuming when we were discussing the balance sheet consolidation. I hope you remember. Now, we said it means every year your subsidiary company has been under providing by 400,000. Your subsidiary company has been under providing depreciation by 400. Then we asked ourselves when we were doing balance sheet consolidation, for how long have they been under providing? We saw that from the year 2007, 1st January, to the year 2010, 31st December, we saw there were how many years? We saw there were 4 years. That is in the year 2007, in the year 2008, in the year 2009 last year, and in the current year 2010. Those were 4 years. And so you remember we were doing an adjustment of 1.6 million for depreciation. We were doing an adjustment for depreciation by 1.6 million. But that's what we were doing when we were doing the statement of financial position. When we were doing the statement of financial position. But now that you are doing an income statement, the question might tell you, listen now, the question might tell you depreciation is considered as an admin expense. Depreciation is considered as an admin expense. Nikusema, or that is to say that every year your subsidiary company has been charging 2 million among its admin expenses. The subsidiary company has been charging 2 million among its admin expenses, but they ought to have been charging 2.4 million every year. So it means whatever profit the subsidiary company is giving you for the current year, don't forget we are doing an income statement, whatever the profit the subsidiary is giving you as their profit after tax, that profit after tax is not pure. That profit after tax is not pure. Why? Because your subsidiary company has been under providing depreciation. So this profit is not pure. So there is no way you can just take 20% of it. There is no way you can take 20% of it now. Now that the subsidiary company was supposed to depreciate by 2.4, not 2 million, it means every year they were undercasting expenses. I have said, suppose the question tells you depreciation is an admin expense. Therefore, it means what this subsidiary company was charging as admin expenses, they were charging there among their admin expense 2.2 million. Every year, they were charging 2 million instead of 2.4 million. So it means now that when you are doing the group income statement, you will take the admin expenses of the holding plus the admin expenses of the subsidiary company, then you will now add the undercharge. You will add the undercharge for that year. Don't forget, we saw the total undercharge for 4 years is 1.6 million. But now we don't use the 1.6 million for the 4 years. Why? Because you know when you are doing group income statement, you normally do it for the year. You normally do an income statement for the year ended, whatever the year. Our current year, we are assuming to be the year 2010. So because you normally do an income statement for only 1 year, then you adjust the admin expenses, not with the total undercharge, but with the undercharge for that particular year, which is 0.4 million. That's what you adjust. So when you are determining the group admin expenses, you take the admin expense of the holding plus the admin expense of the subsidiary company, then you add the undercharge for that particular year. You add the undercharge for that particular year. But our question or our concern was not that. Our concern was how to calculate the non-controlling interest. Now we are saying this subsidiary company, every year they were charging 2 million as admin expenses. They were charging 2 million among the admin expenses as depreciation. So we know, again, we are concluding that this profit they are giving you to be their profit after tax, that profit is wrong. So the question is that profit more than it should be or less than it should be? Of course, they have been undercasting expenses. And every year they were undercasting expenses by 0.4 million, by 0.4 million. What is the effect? What is the effect of expenses being undercasted? When expenses are undercasted, automatically profit is? When expenses are undercasted, profit is? When expenses are undercasted, automatically profit is overcasted. When expenses are undercasted, profit is overcasted. And therefore, we are saying to determine the true profit, you will take that profit after tax of that subsidiary company, then you less that depreciation adjustment, And I am saying, not with the 1.6 million. Yes, when you're doing consolidation of the balance sheet or the statement of financial position, you do the adjustment with the total undercharge. For statement of financial position, don't forget we normally correct the profit of the subsidiary for many years. That means we correct their retained profit. That is what they made for many years. From many years ago up to now, the expense was undercasted by 1.6. So for purpose of statement of financial position workings, you use the total overcharge or undercharge. But when it comes to income statement, you use only the undercharge or the overcharge for that particular year. Why? Because I have said when you're doing an income statement, we don't do it for many years. We do an income statement for the year ended this March, whichever the year, which in our case we are assuming to be the year 2010. So we are saying now that they have been undercharging depreciation every year by 0.4 million, that automatically means the expenses are undercasted. When expenses are undercasted, profit is overcasted. So you come and take the correct the profit they're giving you, you adjust by subtracting that depreciation adjustment, which in our case we are taking to be 0.4 million. Once you do that now you can take the percentage of the non-controlling interest on that resultant amount. For now, we are assuming that the non-controlling interests are controlling 20%. Then I'll say, if the question told you that this is depreciation or depreciation is classified as an admin expense, then I've said you now go to the admin expenses of the group and add another 0.4 million or add another 0.4 million. I hope you still know that if this asset that was supposed to be revalued, but was not revalued, if the asset was a specific asset by the name of plant, maybe it's plant and equipment, plant and machinery, and so on, maybe it's plant and machinery or plant and equipment. For that kind of an asset, listen, the examiner does not have to remind you where to classify depreciation for it. We have assumed that this is depreciation you are being told affects admin expense. But I've said, if the examiner gives you an asset that was supposed to be revalued but was not revalued to be a plant and equipment or a plant and machinery, then it means the examiner does not need to remind you where to adjust that depreciation. I hope you still know, even from your section 3, when you are doing published accounts, or even when you are doing group accounts in section 3, anytime you had to depreciate a plant, there was a specific place where you had to charge that depreciation. Where was it? You had to charge it among what? Among the cost of sales. So I'm hoping you still remember. So if the question is one with the fair value of a plant, then this time you don't adjust it among the admin, you adjust it among the cost of sales, among the cost of sales, whatever it is. So it could be among the cost of sales, or it could be among the admin, depending on the question or the type of asset. If it was supposed to be an office equipment that they were supposed to revalue, but they never revalued, office equipment that they were supposed to revalue, but they never revalued, then automatically you know office equipment used for administration, so you can charge it among the admin. But I'm saying if it's a plant and equipment or plant and machinery that was supposed to be revalued, but they never revalued, then the examiner does not need to remind you where to classify that expense called depreciation. It's your responsibility to know that that depreciation should be classified as a cost of sales item, as a cost of sales item. That's very common in your exams at this section 6 level. It's very common in this section 6. The examiner just tells you fair value of a plant was this, book value was this, and so you know you're supposed to provide depreciation adjustment, and therefore he doesn't remind you where to charge it. Now, we also, when we were discussing this fair value adjustment, when we were dealing with balance sheet or statement of financial position, you also remember we said, what if the fair value of the plant or the fair value of that asset was supposed to be 8 million, but they never revalued. Maybe the book value was 10 million, but the fair value was 8 million. So if they never revalued, again, it means every year the subsidiary company was charging 2 million, was charging 2 million. But now we are concluding by saying, because they were supposed to depreciate an amount of how much? Every year, they were supposed to be charging how much? If the machine had a fair value of 8 million and the remaining useful life was 5 years, then it means every year they were supposed to be charging 1.4 or 1.6 million. But because they did not revalue, they continued charging 2 million. They continued charging 2 million instead of 1.6 million. So now we can see this is a case of an overcharge. This is a case of an overcharge. Again, if you are told depreciation is an admin expense, then you know every year your subsidiary company was charging you 2 million, but they were supposed to be charging 1.6 million. They were supposed to be charging 1.6 million. So it means their admin expenses is overcasted. So when you are doing the group income statement, you should take the admin expense of the holding plus the admin expense of that subsidiary company, then you less that depreciation overcharge of 0.4 million again. But then don't forget, we said if it's a balance sheet question, you will need to multiply this overcharge by the number of years, which is 4 years. But for purpose of income statement, you only use the undercharge for that particular year. The undercharge for that particular year. Okay. Now, so let us assume it was an overcharge. So we are again saying, because they were supposed to be charging 1.6 among the admin expenses, but they have been charging 2 million, then it means their expenses are overcasted. When expenses are overcasted, automatically the profit is wrong. When expenses are overcasted, automatically the profit is wrong. So this profit after tax they are giving you is obviously wrong. It's obviously wrong. What effect did it have? When expenses are overcasted, is profit undercasted or overcasted? When expenses are overcasted, automatically profit is undercasted. So to correct it again, you will come and take 20% into profit after tax. You will now say, now that the expenses were overcasted, profit was undercasted. So you will now add back that depreciation adjustment. You will now add back that depreciation adjustment. You will add back that depreciation adjustment. And we have said the amount you use is not 1.6 million, but 0.4 million. So it will be, take the profit after tax of that subsidiary, add back the overcharge, add back the overcharge, then it is on the resultant amount that you calculate your non-controlling interest, or what we are calling minority interest. So I am through with the second thing that can make you not just to take 20% of the profit after tax of the subsidiary when you are computing the amount of minority interest in the income statement, or what we call non-controlling interest in the income statement. So that's all for that. That's all for that. We want to go to the third item that sometimes you used to use, even in section 3, that made you again not just to take 20% of the profit after tax. So now remind me that third item. If it is not what we are calling unrealized profit on closing stock, if it's not because of depreciation adjustment, because of fair value adjustment, what is it that you could have come across when you are doing this topic in section 3? What else were you coming across that made you again not just take 20% of that profit after tax? What could it be? Okay, I hope you still remember, is what you used to call intercompany sale of fixed assets. Intercompany sale of fixed assets. So let us assume again for the purpose of illustration that you are told by the question, H Limited sold a machine. H Limited sold a machine which costed H Limited 10 million, sold it to their subsidiary for 12 million, sold it to their subsidiary for 12 million. I'm assuming the question tells you during the year, that means in the current year, H Limited sold a machine costing 10 million to the subsidiary company for 12 million. So if there is an intercompany sale of fixed assets, I hope you still remember, even when we were dealing with statement of financial position, which is the balance sheet, when we were discussing the consolidation of the financial statements or position statement of financial position, or what we are calling balance sheet, we came across an intercompany sale of fixed asset transaction. And I hope you still remember we said when there is an intercompany sale of fixed assets between group members, 2 adjustments are normally done. The same ones we want to apply. When you are told there is an intercompany sale of fixed assets between group members, when we were discussing statement of financial position, we said there are normally 2 adjustments that should be made. Which are these 2 adjustments we said in our some previous class before? We said it's obvious. One of the adjustments you do is what we call unrealized profit. The second adjustment is what we call depreciation. So if this subsidiary company bought their fixed asset at 12 million and the machine costed the group 10 million, then it is obvious our subsidiary company was wrongly depreciating. Our subsidiary company was wrongly depreciating. Let us assume the question tells you the machine had a useful life of 5 years. So this means if the machine had a useful life of 5 years, It means every year, the subsidiary company was charging how much? To them, the machine has a value of 12 million. The useful life being 5 years, it means the subsidiary company must have been charging 2.4 million every year. But then we are asking ourselves, as far as the group is concerned, this machine costed the group how much? The machine costed the group 10 million. Over the same useful life of 5 years, it means our subsidiary company should not have been charging 2.4 million. They should have been charging how much? They should have been charging 2 million. They should have been charging 2 million. So it means, therefore, that our subsidiary company has been over providing depreciation. It has been over providing depreciation. Why? Because every year they were charging 2.4 million, because to them, the machine had a value of 2.4. That's okay for them. So on their own, they were charging 2.4 million instead of 2 million. Again, if the question tells you depreciation is classified as an admin expense, then when you are determining group admin expenses, then it means you take the admin expense of the holding plus the admin expense of the subsidiary company. In their income statement, this subsidiary company was charging 2.4 million. They were charging 2.4 million, which is okay as far as them they are concerned. But as far as the group is concerned, they should not have been charging 2.4 million. They should have been charging 2 million. So it means their admin expenses are overcasted. And so when you're determining group admin expenses, you will take the admin of the holding plus the admin of the subsidiary, and you minus that overcharge, which we are assuming to be 0.4 million. But that was not my concern for now. My concern is, how does it affect the determination of the non-controlling, or what we call minority interest? Again, in such a case, you can't just take 20% of the profit after tax of that subsidiary. You can't just take 20% of their profit after tax. No, you only do that if there are no issues. But now we have issues affecting that profit after tax of the subsidiary company. Yes, the subsidiary is telling me their profit after tax is 10 million. But is that profit correct? The answer is no. Why? Because they were charging 2.4 million every year as depreciation among their admin. But instead, we know they should be charging 2 million. So it means the profit of the subsidiary is wrong. First, is it overcasted or undercasted? When expenses were overcasted, automatically profit was. When expenses are overcasted, profit is undercasted. So in such a case, to determine the minority, or what we call the non-controlling, you will take the profit after tax. Then you can see this subsidiary was overcasting expenses. When expenses are overcasted, profit is undercasted. So to correct it, you add back. So you will add back that depreciation adjustment. You will add back that depreciation adjustment. Once you add that depreciation adjustment, which in our case we are assuming to be 0.4 million, then once you do that, now you can take your 20%. Now you can take your 20% on their profit after tax. So I've explained how intercompany sale of fixed asset can affect the non-controlling interest that normally goes to the income statement. Now, when it comes to intercompany sale of fixed asset, when we were discussing statement of financial position working still, we also said that there are times when the profit of the subsidiary company may be wrong, not because of depreciation like we have said. There are times when the profit of the subsidiary may be wrong because of the unrealized profit. I do hope you remember. And when did we say the profit of the subsidiary may be wrong because of unrealized? We saw it is only when the subsidiary company is the one that sold. So we want to change and now assume not a scenario where H is selling, but we want to assume a scenario where now it is the subsidiary company that sold the machine to the holding. So if it is the subsidiary that sold the machine to the holding company, then this time, who is depreciating the asset? It is not the subsidiary, it is the holding. because it's the holding company that bought that fixed asset. But on their own, the subsidiary company being the ones who sold the machine, that machine which costed them 10 million, sold it to their subsidiary, to their holding company for 12, it means on their own, the subsidiary company recognized a profit of how much? 2 million. They recognized a profit of 2 million. But you know, as far as group is concerned, there is nothing like intercompany item, no. So whenever you are doing group accounts, you normally cancel all intercompany items. So we are now saying where the subsidiary company sold the machine to the holding company at 12 million, that machine should remain in the books of the group, not at 12, but at 10 million, how much it costed S. So S on their own, when they sold, they recognized a profit. That's okay on their own. But as far as the group is concerned, the group has not earned that profit of 2 million. Why? Because the machine will still remain within the group, the machine will still remain within the group, and therefore it will not leave the group. So as a group now, it means we have not yet earned, that 2 million. So whatever the subsidiary is giving you as their profit after tax, whatever the subsidiary company is giving you as their profit after tax, that profit is automatically wrong. That profit is automatically wrong. First, the question is it more than it should be or less than it should be? The subsidiary company is telling us they made a profit after tax of 10 million. Remember, it is them who sold the asset and it's them who recognize that profit. So because they're the ones who sold and they are the ones who recognize the profit, then automatically it means that they have not earned that profit. They have not earned that profit. So to calculate the non-controlling, it will be, again, take that profit after tax, you now less that unrealized profit on the intercompany sale of fixed asset, then it's on the resultant amount that you now take your 20%. It is on the resultant amount that you take your 20%. I hope you have understood that. So when it comes, don't forget, when it comes to intercompany sale of fixed asset, I hope you remember that we are concluding by saying the profit after tax of the subsidiary company may be wrong because of two issues. I hope you have noted that. It could be wrong because of depreciation, or it could be wrong because of unrealized profit. It all depends on who sold that fixed asset. We have agreed if it is the subsidiary that sold the fixed asset to the holding, then the profit of the subsidiary is wrong because of the unrealized profit, or it could be a loss. But it is, most cases, it is normally a profit. We are saying if it is the subsidiary company that sold the machine to the holding company, then the profit of the subsidiary is wrong because of the unrealized profit. I hope you have understood that. Then we have said, what if it is the holding company that sold? If it is the holding company that sold the fixed asset to the subsidiary company, then the subsidiary company was wrongly depreciating. So their profit is wrong, not because of unrealized this time, it's wrong because of the depreciation adjustment. Why? Because they're the ones who are depreciating. I hope you have understood those points. So those are the three items I have reminded you and which you need to remember even now, because we shall be using them several times when it comes to your past papers at this section 6 level. That three things can make you not just take 20% of the profit after tax of the subsidiary company when you are computing the share of the non-controlling interest to go to the income statement. I hope you have understood. One, we have said, is when there is what we call unrealized profit on closing stock under one condition. That is, that it is the subsidiary that sold the fixed asset, the goods to the holding. It is the subsidiary that sold the goods to the holding company. That's one. The second item we have said that can affect your calculation is when you have what we call depreciation adjustment because of fair value, meaning the subsidiary company was supposed to revalue, but they never revalued. They were supposed to revalue, but they never revalued. And therefore, we are again concluding by saying this item called fair value adjustment can also affect your calculation of non-controlling interest. Then finally, we have come across a scenario where there could be an intercompany sale of fixed asset, an intercompany sale of fixed asset. That one we have discussed in details. Now, as we go to the last item that we were to finish last time, how to determine the group retained profit brought down, how to determine the group retained profit brought down. Let me wrap part of this so that I explained how to determine the group retained profit brought down. I told you in general, I am discussing the last item now here. We said in general, if the subsidiary is a case 3 question, where we were assuming you acquired your subsidiary company maybe on 1st January 2007, but by the beginning of this year, 1st January 2010, their drawdown was 10 million. And I said, suppose by the time we were acquiring that subsidiary company, their retained profit that time was 3 million. So I told you that out of this 10 million, there is an element called post and there is an element called pre. We have just said, when we were looking at that consolidation, which is here now, we said, if there are no issues, just come and say, from the time I acquired my subsidiary company up to the beginning of the year, that subsidiary company made an extra 7 million, made an extra 7 million. Then we said, if there are no issues, that's what we said, if there are no issues, just take 80% of that 7 million to be your share, which we were getting as something like 5.6 million, and that's what I added here. That is when there were no issues. But now we are going on and saying there were times when, listen now, there were times when even in your section 3 class, even in your section 3 class, you could not just take 80% of the 7. As much as true, 7 million is what you classify as post-action profit. There are times you don't just take 80% of that amount. There are times you don't just take 80% of that amount. What were some of the items that made you again not just take 80% of that? What are some of the circumstances, or in other words, what are some of the items that you used to come across in section 3 when you are doing this group income statement that made you again not to just take 80% of the 7, as much as is true, 7 million is what we are classifying as post-action profit? I hope you remember there used to be 3 things that made you not just take 80% of that. What are some of those 3 things? I hope you remember them. One is what we call unrealized profit on opening stock, and only where it is the subsidiary company that sold the goods to the holding company. I hope you have understood that one. If there is an element of unrealized profit, don't forget we are doing the group income statement for the current year, and we are assuming our current year is 2010. So maybe you read the question and you are told, in the previous year, maybe 2009, S Limited sold goods to H Limited costing this much and blah, blah, blah. Then you realize by end of last year, our holding company had not sold. Our holding company had not sold all or part of those goods. So it means in the previous year, which is 2009 here, somewhere the subsidiary last year recognized a profit, which as far as the group is concerned, they should not have recognized. I hope you're getting the point. Not in the current year. Our current year is 2010. But now we are saying in 2009, which is the previous year, last year, our subsidiary company sold goods for whatever the match to H Limited, and by end of the previous year, H Limited had not sold either all or part of those goods. So we are concluding by saying, as a subsidiary company, you are saying, yes, you made a profit of 7 million. Yes, you as a subsidiary, you are saying you made a profit of 7 million from the time I acquired you up to end of last year. But then the question is that 7 million a clean profit as far as the group is concerned? No, it's not a pure profit of the subsidiary company. Why? Because in the previous year, they recognized a profit they should not have recognized. And so let us assume the question is where the unrealized profit was maybe 0.5 million, 500,000. So we are concluding by saying you can now not just take 80% of the 7 like we were saying when I was illustrating here. No. Why? Because that profit is wrong. So what do? You will now take that 7 million, you minus the unrealized profit of the subsidiary company on the opening stock. Remember, opening stock is the closing stock last year. The opening stock of this year is the closing stock of last year. So you take that 7 million, you minus the unrealized profit on opening stock. Then once you do that, now you get the pure post brought down, and now you can take your 80% on that one. You can now take your 80% on that one. I hope you have understood that point, that we are saying that when you have unrealized profit on opening stock, you don't just take 80% of the 7. No, you first get the pure post brought down. Once you get it, now you take 80% of that profit. That's one. That a scenario may be given where you not just take 80% of the 7 million. No. Which is this other one? The second one is what you used to call depreciation adjustment of the previous years. Let me take you back here again. When we were dealing with fair value. We saw, let's go back, and we are saying, assuming an asset has a book value of 10 million when we were acquiring it many years ago. And I'm assuming we acquired our subsidiary company on 1st January 2007. Then you are told that asset had a fair value of 12 million. We saw a short while ago that this subsidiary company, because they never revalued, they went on charging 2 million every year. But had they revalued from 10 to 12, we saw they should have been depreciating that asset by how much? By 2.4 million. That's what we say. Now that the subsidiary company was wrongly depreciating, were they undercharging or overcharging? Automatically, they were undercharging, because they should have been charging 2.4 million as far as the group is concerned, but they went on charging 2.4. They went on charging 2 million instead of 2.4. So every year, our subsidiary company was under providing depreciation by 400,000. When we were discussing income statement, I said, you will now come and correct this. They were charging here 2 million. We said, when you are told it's an admin expense, we said you now come and add back that 0.4 million. When we were doing the income statement, we said income statement is for the year. So we corrected the admin expenses with the undercharge for the current year 2010. But don't forget, In the year 2007, they underprovided by 0.4 million. In the year 2008, they underprovided also depreciation by another 0.4 million. In the year 2009, they also underprovided by another 0.4 million. But in the current year, 2010, they also underprovided. That's why you remember we were getting a total overcharge or undercharge, sorry, of 1.6. We were multiplying by 4 years. But my point is this. We are not correcting the profit from this 2007 to end of 2010. We are saying from the time I acquired that subsidiary, company, which is 2007, up to end of last year, they are claiming to have made an extra 7 million. From the time I acquired that subsidiary up to end of last year, 2009, which is the whatever is they brought down this year, they are claiming to have made an extra 7 million. So the question is, can I take 80% of that 7 million? The answer is no. Why? Because that subsidiary company wrongly depreciated in the year 2007. They undercasted depreciation by 400. They also undercasted another depreciation of 400 in the year 2008, and in the year 2009, they also undercasted by another 400. For the current year, I have already corrected that issue. Why? Because I came to the income statement and I added the undercharge. But now we are saying this subsidiary company claims to have made an extra 7 from the time I acquired them up to end of last year. That 7 million is not pure. That 7 million is not pure. It's wrong. Question is it more than it should be or less than it should be? Our subsidiary company has been undercasting expenses. They have been undercasting expenses for those 3 years. For those how many years? 3. From 2007, 2008 to 2009, that's what affects our previous year. So we are saying there is a total undercharge. There's a total undercharge for 3 years amounting to 1.2 million. For 1.2 million, I've said for the current year, I have already corrected. When I went to the income statement, I added the 400 depreciation. But there's another undercharge of 2007, 2008, and 2009. And that 3-year period affects not the profit for the current year. That 3-year period affects the profit from last year backwards, which is that which we are calling post brought down. So you will obviously now say this 7 million is not pure. As much as they are claiming 7 million is the post brought down, that 7 million is not pure. As far as the group is concerned, is not pure as far as the group is concerned. So what do? You will now come and take, that 7 million, you will say, because the subsidiary company has been undercharging. Every year they were undercharging depreciation. Were they overcasting the profit or overcasting the profit? Whenever the expenses are undercasted, profit is normally overcasted. So you will correct that by minusing that 1.2 million depreciation. You will minus that 1.2 million depreciation. From the 7 million post, you minus that 1.2. Then once you do that, then you can now take your share as 80%. Now you can take your share as 80%. I hope you have noticed and I've said that this 7 million I'm claiming as post brought down, it's not wrong because of the depreciation adjustment for the 4 years. It's wrong because of the previous years depreciation adjustment. Previous years, not current year. For the current year, you corrected the admin or wherever you are told. But now, because we are dealing with the retained brought down of that subsidiary, which is the profit they had from the end of many years, from the beginning of many years up to end of last year, that 7 million they are claiming as post is not pure. So you correct it first. I hope you have understood that point. That when there is what we call depreciation adjustment of the previous depreciation adjustment of the previous years. That's the key issue, of the previous years. Why? Because we are correcting the profits not of the current year, but of the previous years. We are correcting the profit of the previous years. So that's all as far as the second item is concerned. So we have come across two things that could make you, or were making you, not just take 80% of the 7 million, as much as we conclude 7 million is a post brought down. Yes, one is what we have said, is when there's an element of unrealized profit on opening, unrealized profit on opening stock, and it is the subsidiary that sold the goods to the holding company. That's number one. Not in the current year, but they sold to the subsidiary, to the holding, in the previous year. When there's an element of unrealized profit on opening stock, and it is the subsidiary company that sold the goods to the holding company in the previous year, in the previous year. Number two, second item is what we have called depreciation adjustment of the previous years. Whenever there's a depreciation adjustment and it affects a previous year, that's another issue we have said, which you have to deal with. That depreciation adjustment may not be just because of fair value adjustment. It could be because of intercompany sale of fixed asset. Maybe last year they sold to each other some fixed asset, last year or previous years, and therefore that subsidiary company was wrongly depreciating, and therefore, again, it will affect their profit for previous year. So when I say depreciation adjustment, it does not mean only on fair value. It could be also on intercompany sale of fixed assets. Okay, what was the third item that made you not just take 80% of the 7 million? As much as you are concluding 7 million is the post. What was this third item that at times made you not just to take 80% of the 7 million? Okay. Before I give it to you, let me take you back here. We are still using this scenario where we are assuming you acquired your subsidiary company in the year 2007. We are assuming you acquired your subsidiary company in the year 2007, and we are assuming you are consolidating on 31st December 2010. You are consolidating on 31st December 2010. So let us assume that when you acquired that subsidiary company, whatever their date, which I'm assuming now is 2007, maybe you calculate and you see the goodwill of that subsidiary company that time was 4 million. You are told, or you calculated, the day you acquired that subsidiary company, you computed their goodwill and you found it was 4 million. Maybe the question tells you goodwill suffers an impairment loss at the rate of 10% per annum. Maybe you are told goodwill suffered an impairment loss at the rate of 10% per annum. So it means in the year 2007, that goodwill suffered an impairment of 400. In the year 2008, that goodwill suffered an impairment loss of another 400, which is 10% of 4 million. In the year 2009, that goodwill suffered another 400. In the current year, 2010, that goodwill suffered another 400. When we were discussing the format of the income statement, we said if there is any impairment loss of the goodwill of the subsidiary in the current year, I told you, charge it here. Don't forget, we are doing the income statement for the current year. So that 400 for the year 2010 is what you must have charged. For the year 2010, I'm assuming you are doing your income statement for 2010. So we are saying that income or that impairment for the current year is what you must have charged as the impairment loss. You did not charge the impairment for the 4 years. You charge the impairment for the current year. Why? Because you are doing the income statement for the year. You are doing the income statement for the year. Now, but don't forget, this goodwill has suffered an impairment loss from the time I acquired it up to the end of this year. That goodwill has suffered an impairment loss of 1.6 million. Every year, the subsidiary was supposed to impair their goodwill by 400, 400, 400, and another 400. For the one of the current year, I have charged for them that one of 400, which is here. But don't forget, in the year 2007, in the year 2010, and in the year 2009, last year, up to last year, these guys were supposed to charge cumulatively for those 3 years, they were supposed to charge an impairment of how much? 1.2 million. For those 3 years, they were supposed to charge an impairment loss of 1.2 million for those 3 years. But remember, again, they are claiming that their profit they made, the profit they made from the time I acquired them up to last year, from the time I acquired them up to the previous year, they are claiming to have made a profit of 7 million. From the time I acquired them up to end of last year, we are assuming they claim a profit of 7 million, which is what we are saying here. So on this circumstance, again, for this circumstance, again, you cannot take again 80% of the 7 million. No, you can't take 80% of the 7 million. Why? Because this time, the subsidiary was supposed to impair their goodwill. In those previous years, they never charged. For the current year, I've charged it for them, 400. But what about the impairment for 2007, the impairment for 2008, and the impairment for 2009? It still affects their profit, but which profit is it affecting? It affects what they are claiming to be they are brought down by the beginning of the year, which is this 7 million. So that 7 million is wrong. That 7 million again is not pure. Is it more than it should be? Less than it should be. Remember, our subsidiary company was supposed to impair their goodwill by 400, they never did it. In the year 2008, they were supposed to impair by another 400, they never did it. In the year 2009, they were supposed to impair their goodwill by another 400, they never did it. So for those 3 years, our subsidiary company or did not charge, well, put it that way, did not charge impairment cumulatively of how much? Of 1.2. So if within the same period, they are claiming their profit was 7 million, and within that period, they were supposed to impair their goodwill cumulatively by 1.2 million, then this 7 million again is wrong. First, is it more than it should be, less than it should be? Is it more than it should be, less than it should be? That profit. Obviously, it's more. So there is no way you can take 80% of that 7. So how do you calculate your share? Yes, as much as the post is 7 million, how do you calculate your share? Tell me this. Can I take 7 million, I minus 1.2 million, then I take 80% of that? Can I take 7 million, I minus 1.2 million, which is for the last 3 years, then I take 80%? When it was depreciation of the previous year, I hope you can see here, that's what we did. When it was depreciation of the previous year, that's what we did. But now, when it is goodwill, and we are now mentioning the third item that makes you not to take 80% of the 7 million is what we can call goodwill impairment of the previous years again. Goodwill impairment of the previous years. The key word again is the previous years, not the current year, the previous. Where when there's goodwill impairment of the previous years, that also can make you not just take 80% of the 7. But the question is, can I take 7 million, I minus 1.2, as much as we have agreed profit was more than it should be? Can I take 7 million, I minus 1.2, then I take 80%? The answer is no. Why can't you do this? The reason is, I hope you still remember, the reason is that goodwill that you acquired of the subsidiary company, that goodwill that you acquired in the year 2007, that goodwill was already at 80%. When you are calculating goodwill, I know you know from group accounts, you normally use your percentage of control. If you control 80, you normally use 80% to calculate the goodwill, So that goodwill that you acquired, when you are acquiring that subsidiary company, being that you used 80% shares to calculate that goodwill, and you got a goodwill of 4 million, it means, and you know in group accounts, that goodwill is equivalent, is 80%, So being that it's already at 80%, then to calculate the group share, you will now take the 7 million, take 80% of it, which means you come and take 80% of the 7 million, then you now minus that 1.2 million. You don't subject, that's the point I'm trying to say, you don't subject the 1.2 million to 80%. That's what I'm hoping you're getting. You don't subject 1.2 million to 80%. Why? Because goodwill on its own is already at 80%, is already at 80%. So first you get 80% of the post brought down. Once you get the 80% of the post-action trade profit brought down, then you less the goodwill impairment of the previous years. You less the goodwill impairment of the previous years. I hope that point has been understood. Because that's very important when it comes to goodwill. So it's not like depreciation. Depreciation is already at 100%. So you just subjected depreciation to 80% again. But for goodwill impairment, you only have already taken your share of that. It was already your share. So you can't subject it again to 80%. You can't subject it again to 80%. So that brings me to the end of that discussion as far as the 3 items that can make you not just take 80% of the post-action trade profit brought down, not to just take 80% of the post-action trade profit brought down. As much as true, the post was 7 million, but we have said there are times you don't just take 80% of that. So that is what we are concluding by saying that those 3 items can affect. So I'm hoping you have noticed that when it comes to group accounts, and especially income statement, one area you should be very careful as far as the question is concerned is how to determine the cost of sales for the group, how to determine the non-controlling interest that normally goes to the income statement. We saw 3 things again that may make you not to just take the profit after tax 20%. You remember, there were those 3 items. The other area we have emphasized is how to determine the group retained profit brought down. The group retained profit brought down for the group. You don't just take 80% of the post brought down if there are any of these 3 issues. 1, unrealized profit on opening stock, where it is the subsidiary that sold the goods to the holding in the previous year. 2, depreciation adjustment of the previous year. 3, goodwill impairment of the previous year. Then I've emphasized how to use the depreciation, you minus, and the goodwill impairment, you don't subject it to 80%. You don't subject it to 80%. Now, so far, so good. So before we do a past paper question, on that area, let me take you back again Let me take you back again. Whenever you are given a question of income statement to do, whenever you're given a question of income statement to do, we have said it must be any one of the following cases. It could be a case where you acquired your subsidiary in between the year. It could be a case where you acquired your subsidiary company in between the year. And so let us assume that you acquired your subsidiary company on 1st July this year. And we are assuming the year is ending on 31st December. So if that is the case, then tell me this. When you are given this as the income statement of H Limited, and you're given this as the income statement of S Limited, when you are doing this in section 3, remind me this, were you just taking the sales of the holding company plus the sales of the subsidiary company, like I've been doing? If you acquired the subsidiary in between the year, that means you're given a case 1 question where you acquired your subsidiary in between the year. The question is, were you just taking everything of the subsidiary of the holding plus everything of the subsidiary? The answer, I hope you remember, is no. The answer, I hope you remember, is no. Why? Because you know when you acquire a subsidiary company, that subsidiary company should be consolidated from the date of acquisition. It should be consolidated from the date of acquisition. Meaning, if you control it for 6 months, I know you are supposed to take plus 6/12 of the subsidiary's results. So you come and take the sales of the holding plus 6/12 of the subsidiary's sales, you minus any intercompany sales if they're there, then you do the same for the cost of sales, take the one of the holding plus 6/12 of the subsidiary's cost of sales, minus any intercompany sales if they're there, and so on. In other words, I'm saying, if you acquired a subsidiary company in between the year, then that subsidiary company should be consolidated from the date of acquisition, should be consolidated from the date of acquisition, meaning you time apportion the results of that subsidiary. If you control it for 3 months, you take plus 3/12. If you control it for 6 months, you take everything plus 6/12, plus 6/12. That's what we are trying to say. So that's how you deal with a case number 1. If it was another case where you acquired your subsidiary at the beginning, then you add everything because you have controlled the subsidiary for the whole year. If you acquired the subsidiary many years ago, like we have been using, then you consolidate everything. But for case number 1, where you acquire a subsidiary in between the year, you don't consolidate everything of the subsidiary. You only consolidate them from the date of acquisition. I hope you remember that point. So that brings me to the end of that area, or that brings me to the end of the topic today. Then next time we shall continue from there. Next time we shall now continue from there and deal with other items. Now we shall continue from there and deal with other items. Then we shall also do maybe a past paper question maybe next time. So for today, maybe we can stop there. We pick it up from there next time. So see you next time.